Welcome to 2019. Mathew, Cassidy, Managing Director. 2019 is looking like a very interesting year. We've got a lot of matters on not only the domestic but also the international environment, which we really need to be keeping a close eye on. So we're certainly aware of a number of those issues. Important to, if you have any concerns about any various matters, to connect with your advisor, and we'll look forward to being very active in terms of various matters and being on top of them to ensure we not only protect but grow your wealth and prosperity. Thank you.
Hi there, it's our January investment market update, and fingers crossed 2019 starts in a better fashion than we saw the end of 2018. It was a pretty disappointing last quarter of the year, and December actually was one of the biggest losses for the S&P intra-month that we've seen in many years. The Aussie share market closed down in 2018 for the first time since 2011, and equity returns were down just under 3% for the year, including dividends. So a little bit disappointing, and most of those losses came in the back half of the year. Globally, we saw concerns start to pick up after what's been a really phenomenal 8 or 10 year bull run. Concerns now on a peak in US corporate profit growth, a peak in the US economy, some concerns on trade, obviously, that have been well reported in the press. The slowdown in China is having a bit of an impact as well on profit outlooks, and locally here in Australia, we've had the ongoing impact of the Royal Commission on bank lending, and as a result, we've seen liquidity to the economy really start to drain back. In fact, in Australia, money supply growth at its lowest rate of growth since the early 1990s recession, and this is a function that we're seeing in investment markets globally. Australia liquidity concerns are the same as what is being witnessed in the United States, where the Fed are reining in their balance sheet after 10 years of very heavy money printing, and indeed in China and Japan and Europe, again, that very strong excess supply of money that's fueled share markets in the past decade is now starting to be unwound. So as we look into 2019, those trends won't reverse. So I do think we ought to have a cautious outlook looking into 2019. But on the positive front, the losses at the back end of 2018 have set us up at the start of the new year with a better valuation and perhaps a better base for building the year. So with all that in mind, some of the things that perhaps we should be looking out for in 2019 would be as follows. Locally, it's a bit of a no-brainer that the federal election in May will be something very closely watched. We've started to see a deterioration in the last couple of months in Australian business confidence, and that's a function again of the uncertainty as to who indeed will be governing this country by May. The uncertainty over housing is another issue which clearly will start to hit consumers' hip pockets. The household wealth effect there will be working in a negative fashion in much the same way that it's worked in a positive fashion in the past couple of years. But hopefully we'll see some respite for the local economy by ongoing infrastructure spend and by weakening in the Australian dollar. At a global level, clearly we'll want to see the ongoing trade shenanigans between the Chinese and the Americans resolved. The US have said that they've given China a deadline of the 1st of March to come to the party on issues around intellectual property before the US start to throw additional tariffs on Chinese goods. So hopefully by the 1st of March we'll see that situation resolved, and clearly it's in the best interest of both countries to get that resolved, because China's growth is actually at multi-year lows at the moment and showing no signs of turning around, and indeed the Chinese authorities are not so keen to throw the stimulus at the economy in a fashion that they have in the past. And in the United States, at least, we've had the economy at really 20-year highs in terms of strength, now coming off the boil. There has been an impact on small business confidence from the trade issues, and Mr. Trump's not unaware of that. And with 2 years left to run on his presidential term, he'll be very keen to get the economy and indeed the share market moving again. So with a bit of luck, we get some resolution on that in the first month or two of the year. But again, the overarching theme for 2019 will be much like 2018, and that is that the stimulus and support from central banks globally simply won't be there in the way that it has been in the past. And so I think the great likelihood is that 2019 will be a year of modest gains for portfolios, with some risks still on the downside. But fortunately, as I said before, 2018 ended up on such a bad note that we're starting from a much firmer footing, if you will, from a valuation standpoint.